Today is the day that crypto industry stops arguing in theory and starts fighting over one word: yield. Coinbase just pulled support from Senate's market structure bill, and banks are lobbying with more than 3,000 signatures to ban rewards. The draft includes a mechanism that could create a two-tiered crypto market overnight. If you hold stablecoins, trade DeFi, build tokenization, or just hold any major tokens, this one bill can rewrite your next 5 years. Today in the Control Loop, we have Mansi, our legal expert at the top exchange. Mansi, set the stage. What happened this week with this bill, and why is it bigger than just Coinbase headlines?
So what happened is the Senate Banking Committee has put out a crypto market structure draft aiming to define how the SEC and CFTC will oversee crypto markets. Coinbase has publicly withdrawn support, arguing that the draft is actually worse than the status quo. And pointing to multiple deal breakers, including tokenized equities, DeFi treatment, the CFTC approach, and they've also suggested possible amendments. This matters because market structure is a regulatory operating system. It decides what can list, what can trade, which products are legal, and what compliance looks like for years to come.
So, but where is this bill right now, like legally, in terms of when can we expect it come to actually public? Where is it today? What's the process for it in the reality of the Senate?
So the committee has actually postponed its planned markup because the negotiations are still ongoing. The public signal from the Senate banking is that they intend to keep working, revise, and will reattempt consideration once they have a viable path forward. In plain English, this is not dead, it's being retraded. The bill's final shape will depend on what they can unify around on stablecoin rewards, DeFi, and political constraints.
But there was a headline that Coinbase has objected to certain points in this bill, and we know Coinbase is one of the biggest player, and they would be pulling off their support. What are the actual things that they were against in this, just for us normal folk?
So Coinbase's stated objections can actually be put into 4 buckets. The first one being tokenized equities. Armstrong has called it a de facto ban, meaning the bill structure would actually make tokenized stocks practically non-viable for crypto platforms. The second one being DeFi. The drafts and amendments risk pulling decentralized protocols into compliance regimes that don't actually map cleanly to code-based systems and that are actually meant for TradFi. The third one being the CFTC structure and jurisdiction. If the bill market plumbing is wrong, it creates a lot of uncertainty for exchanges and brokers and market makers and everybody that it takes to build efficient markets. And the fourth one being the amendments. The bill is still in a heavy edit cycle. Coinbase is signaling it will not endorse a draft that locks in the wrong defaults.
But everybody's been screaming that, like, the way it's today written, the bill, it lets the banks win and basically ends the stablecoin yield war. But what does it actually technically say about stablecoin rewards, and why is it a win for the banks as it stands today?
So the draft actually draws a bright line. There is basically no interest solely for holding a payment stablecoin can be given to a user. It prohibits a payment stablecoin issuer from paying interest to holders, and it also blocks intermediaries from paying interest just because you're passively holding a stablecoin. But it also creates a key exception which allows activity-based incentives tied to use like payments, transfers, and other permitted activity. So the bill is actually trying to kill passive yield while leaving room for rewards framed as active usage incentives.
And how hard are the banks actually fighting this? How big is the lobby of the banks that would lose half of their business if stablecoin yield was actually allowed?
Well, the American Bankers Association delivered a petition, which has been signed by more than 3,200 banks, pushing Congress to ban stablecoin yield and rewards. The argument is straightforward. If stablecoins can offer yield, deposits move. That threatens the bank's funding model and the local lending narrative. That 3,200 figure is a signal. This is not a niche complaint. This is a coordinated political muscle move. So if this language survives as it stands today, passive yield as interest for holding gets legally radioactive in a sense, but the bill explicitly leaves a lane for incentives tied to activity. That means product teams will engineer, pay, spend, transfer, route, stake, and interact with that platform. The result of that, yield may not disappear. It may become conditional, behavior based, and packaged as rewards. That is a major UX and product shift.
So then another thing that's in this bill is, except from yield, is things like around DeFi and KYC. Everybody says like, oh, we just have to regulate DeFi, but it is technically actually hard. So what is the problem also on the legal side for DeFi and KYC?
The real problem actually is mismatch. Law likes accountable intermediaries. DeFi often has none. So the bill and the amendments become a chess match over who counts as a control person, what is a front end, responsible for, and whether protocol developers can actually be treated like operators. If the lawmakers push too hard, DeFi either exits the US, geofences, or becomes permissioned. If they carve it out too much, then they get attacked on AML risk. That's why DeFi language is one of the most contentious parts of this whole market structures act.
But DeFi is also very tied to things like self-custody, decentralization, and all of that. So what about like self-custody? Does this bill like protect it, or doesn't weaken it and saying that everybody is going to have to custody with somebody who is accountable?
So self-custody is one of the political red lines in this entire debate. The pro-crypto coalition wants explicit protection that agencies cannot effectively ban self-hosted wallets. But the practical battleground is not wallet possession, in so much as it's what happens at on-ramps and off-ramps. That's where KYC reporting and surveilling debates concentrate.
Well, it's just not for the part of just the crypto itself, but the same applies to like tokenized equities. One of the points that Coinbase brought up was that the bill the way it stands today basically bans de facto tokenized equities. But we've been saying that it's like a next $1 trillion product in the actual future for crypto. So why would a market structure bill try to restrict that?
Because tokenized equities are still equities. Regulators treat them as securities. The SEC's posture currently is if it is a tokenized security, securities law still applies. That means broker-dealer, ATS, exchange rules, custody rules, disclosures, all of the traditional rails apply. Coinbase's de facto ban argument is basically can be broken down as if the bill forces tokenized equities into full securities infrastructure without a workable bridge for crypto platforms, then the product itself becomes impractical at scale in the near term. Other industry voices disagree and argue that the bill can actually enable tokenized securities by clarifying how the digital rails fit existing securities plumbing. But that split is real and it's really hard to say which way it will go.
Yeah, I bet it's hard to say which way it will go. There's amendments coming out daily and we keep hearing like insane numbers. Is this true, and how bad is it?
Well, reporting has indicated upwards of 100 amendments, including like a figure of 137 filed around the markup process. This matters because the market structure is not a single issue bill. It is jurisdictional war between SEC and CFTC versus banking regulators, plus all the politics around it. In this kind of a process, one late amendment can flip an entire product category from legal to non-viable overnight, making a lot of businesses non-viable. That's why stakeholders are reacting so aggressively in public.
So one more thing that we want to understand from this bill is who benefits and basically who gets crushed the way that the various crypto projects are today. So from like a neutral perspective, who are the winners and losers in the draft the way it is today?
Well, the likely winners could be the biggest tokens and platforms that can comply, plus products that fit cleanly into the CFTC style commodity lanes. Mixed outcome, stablecoin issuers and exchanges, because passive yield actually gets restricted, but the activity-based rewards may survive. The big risk zone really is DeFi protocols and tokenized equity products, because they can get trapped in compliance requirements designed for intermediaries and which are not actually meant for them. And there is a macro winner nobody talks about, the US, which is if it gets a workable framework, because capital and builders stop playing regulatory roulette, and all the mine capital in crypto that was caused by the previous governments actually makes its way back to the US.
Yeah, well, we can start celebrating the maturation of the space. Now you know what you can and cannot do. But which tokens that are in the market today can actually claim to become commodities on day one, and like why? Because one of the explosive parts of this bill is the big idea of the tokens that are underlying already have exchange traded funds will become immediate commodities on the day this bill is actually made into law. So which are those and why?
The draft actually contains an explicit fast lane. For example, if on 1st January 2026, units of a network token were the principal asset of an ETP listed on a national securities exchange, that token automatically is not a security under the covered securities laws, and that pushes it into the commodity lane in practice. So the real world day one set is tokens with US listed ETPs already live by the 1st of January 2026. Based on ETP launches and listings before the beginning of this year, the list includes BTC, ETH, Sol, LTC, XRP, Doge, Link, and a couple of others maybe. The caveat that matters here really is the bill's trigger is principal asset. If an ETP is only partial exposure or structurally structured slightly differently, then lawyers will debate whether it qualifies for the commodity lane.
So this basically creates like every token is equal, but some are more equal than others, basically second order effects. But then what happens for everybody who's not in the first lane?
You get a two-tier market. So the tier one is ETP backed, not a security tokens. Easier institutional rails, lower existing listing risk. Then there's a second tier, which is everybody else, much slower pathways, higher compliance uncertainty, potential liquidity discount. This will actually concentrate liquidity around the fast lane and pressures projects to chase ETP eligibility. That changes incentives around the entire industry.
And what is the likeliness basically of it to land? It is, what are like the path forwards for the next time? What is this, let's say, most likely scenario? So where this can go from today?
Yeah, so maybe the first scenario, a compromise passes. Passive stablecoin interest stays banned, but activity-based incentives survive. DeFi gets partial carve-outs plus targeted AML hooks, and this is the narrow win path. The second scenario could be the bill slips, too many amendments, too much political heat, and it gets kicked further down the calendar. Postponement already signals fragility. And the third and the worst case scenario is a bad Clarity Act passes. It is called Clarity, but it entrenches incumbents, weakens DeFi, blocks tokenized equities on crypto rails, and exports innovation offshore. This is what Coinbase is trying to prevent.
Well, thank you, Mansi. That has been very informative. Let me try to recap it for listeners. So the reality is that this build is not just the Coinbase interest story. It's a story of US trying to gain financial power over crypto. So the draft today draws a line. There is no passive stablecoin interest, but it does leave a loophole for activity-based incentives the way it stands today. So that is not a small change. That is basically product redesign for entire consumer stablecoin market. Then it also contains a mechanism that creates day one fast lane tokens into two-tier market to become a principal asset of listed ETPs. And that's how you get the tokens that are better than the others and the commodities. And the political signal coming out of all of it is unmistakable. More than 3,000 banks are lobbying to shut down stablecoin yield and rewards. That means that's hurting them. And the next episode, we will try to map exactly which DeFi designs can survive under the most likely compliance outcomes, and what the builders in crypto should do to stay tradable in the United States. Thank you everybody for listening. Thank you Mansi for this very informative discussion, and see you all in the next episodes of the Control Loop.